we've been preparing this update for a long time, and a lot of you have been waiting for it. But finally, as of June 20th, we're preparing a full update on everything to do with China direct shipping from China to the US and what the China to US tariffs and the de minimis elimination has impacted things so far. So it is June 20th, and it has been a while, and there's been a lot of things that's been happening through time. So keep in mind that there's been a lot of other updates before this that go into the details of the timelines of the initial tariffs, de minimis elimination. So we'll link some of those materials down below in the description. So we're not going to go through the whole history of that and really just more focusing on the update of what's happening since then. But more importantly, and this is where you really want to tune in on, where has the impact been on direct from China to US parcel fulfillment using something like UniExpress? And as a teaser, it's actually looking very stable. But let's go through the full update, and it's very important for you to understand the nuances of how they actually work. All right, so what we're gonna go over today is we're gonna have the latest update on China tariffs to the US and de minimis elimination. And second, very important, technical considerations on D2C parcel shipping from China. We're going to give a little bit examples, details of the current shipping line options from the top private couriers, and some case studies, some analysis with real numbers. So let's get started. So first of all, who is this for? Okay, so this is very important. So this is specifically for D2C e-commerce brands selling to US consumers. So not for Chinese sellers, okay? So D2C e-commerce brands selling to American consumers. And by the way, this is only focused on the US right now because that's where the tariffs actually matter. Second, you have to leverage direct from China parcel fulfillment using private couriers, so not freight, for example. And you have to manufacture and hold inventory in China in order to ship from China. And you have to own physical inventory. So this is not for drop shipping, which is a completely different animal. All right, so let's get started. So what has been happening recently? And again, this is relevant as of June 20th. So the tariffs on Chinese goods have reduced from 145% to 30%. And let me kind of just describe what has happening on a very basic, on a very high level since February 2025. So February 2025, and then in March, there was these 2 rounds of 10% tariffs called the fentanyl tariffs. And by the way, important, none of this includes base and Section 301 tariffs, okay? And then this reciprocal and trade war tariff started. So there was this 34% on April 2nd, there was this 50% extra, and then 41% extra for a total of 145%. So this was kind of peak China-US trade war tariff at 145%. And then what happened in May was there was this tariff pause. And so this was kind of confusing to understand at first, okay? So first, these fentanyl tariffs still exist, all right? And then what happened was this April 2nd, 34% was then reduced. So this is the reciprocal tariffs, okay? This was reduced to 10%. And then these other 50, 41% trade war tariffs, you call it, have been eliminated by then. And then technically this 34% to 10%, it was technically paused until August 13th, 2025. So this is where that 30% comes to. And again, this does not include base and Section 301 tariffs. And then, okay, so what's up with this 55% deal? So I'm sure you guys remember this. Our deal with China is done. Subject to final, so this is important, subject to final approval with President Xi and me. And by the way, as of June 20th, I don't think there's any indication that there's actually a final approval yet. So it's kind of this is not even completely formal. And at the time, there was a lot of questions about what the heck is this 55%? And then there was an article, and we linked to it below as well, is, okay, so our understanding is, or Reuters' understanding at least, the article's understanding is that 55% represents the 10% reciprocal tariffs, plus this 20%, they call it punitive measures, but that's the fentanyl tariffs. So that's 30%. And then the 25% is really weird because this is where the pre-existing 25% levies on the imports from China are. And just from the timeline, technically it's supposed to be the Section 301 tariffs that's always existed. Now, the slightly weird thing about this is that the Section 301 tariffs are up to 25%. So it's not exactly 25%. So there's still like not 100% clarity on what this 55% actually means. However, the basic understanding is that like this deal didn't really change anything. This deal just kind of goes back to this like technically 30% plus the Section 301 tariffs anyways. And I'll give you guys an example of like what that actually means for real products. So remember, none of this includes base tariffs and Section 301 tariffs, okay? So there are two examples of different HTS codes. So like office supplies versus women's woven trousers. And they have different base rates. This is 5.3, this is 28.6%. And then now this is where Section 301 gets a little bit interesting. So some products actually don't have Section 301 tariffs. In this case, women's woven trousers is 7.5%, and it could be up to 25%. So this is where there's still a little bit of unclarity about like where this 55% comes from, because technically it should be up to 55% if it includes the Section 301. But basically like, and then adding on all of the other fentanyl tariffs or reciprocal tariffs. So you see, adding on everything together, as our understanding, there's still going to be different tariff rates. And you see, like in this case, it's actually less than 55%. In this case, it's more than 55%. So again, we have no clarity on exactly if this is approved or not, and we have not full clarity on what that 55% actually stands for. So stay tuned. Certainly, as soon as we learn more, we'll get you updated. Now, so for China direct shipping, parcel shipping at least, this is what, of course, the most important part is the $800 de minimis exemption. So it has been formally eliminated. There are a couple times where maybe it'll come back, but no, it is eliminated. And right now, we and the entire logistics industry is going to assume that de minimis exemption is not going to come back, at least anytime soon. So we're assuming that the stable state is no de minimis exemption, and that stays eliminated. However, despite all of this, the good news, and this is what really matters actually for anyone who actually uses China parcel shipping, is that it's more or less getting back to normal. So here, just like a couple of quick views. So for example, we're talking about rates. The U.S. parcel rate ordinary for 200 gram was as high as almost $10. But now currently it's like $6.78, which is only like $1 like more expensive, or less than $1 more expensive than its previous low of last year. So this is very, very close to being back to normal, similar to the regular line as well, slightly more expensive, but still actually the regular line is only 80 cents more expensive than the low end last year. And if you think about it, for a 200 gram parcel, if you have an ordinary, which is like no batteries, and you're paying like $6.78 to get that parcel to your US customer, like that's really not bad at all. And then the shipping times have really, really stabilized as well. So I'm not going to go over this that much. At the end of this, I'm going to go over a full analysis and go through some spreadsheets as well. But basically, we're looking at like the 90% range, comparing a batch of packages sent in March versus a batch of packages sent in May after de minimis has been eliminated. And we actually see, so this is the ordinary line, and in the fiscal, so like the faster range is actually very, very similar. And on the slower range, we're talking about like 15.5 days versus 13.7 days, which is like just under, it's really not that big of a difference. It's like, a day and a half of a difference, which is really not bad considering the situation. And then similar to regular as well, looks very similar to before. Actually, like on the short end or the fast end is a little bit faster than before, and then on the longer end it's very, very similar. And then both of these have some outliers as well. However, I'm going to go over a full analysis and actually go through some spreadsheets and explain like what these shapes mean at the end. So stay tuned for that. However, before I do that, it's very important for anyone to actually understand the nuances of how these lines actually work after de minimis has been eliminated, and what does T11 mean, what does DDP mean. All right, so We'll get to like more detailed analysis later, but let's talk about like, okay, what does this all actually mean and how D2C parcel shipping works now compared to before? So first, if you don't know these terms, these are very important to understand. IOR, which is the importer record, the consignee, and the customer. So the IOR is actually someone who is, or an entity that's legally responsible. And the responsibility is customs compliance, and the legal risk is on the IOR. The consignee is the physical recipient of the shipment, and they're the ones responsible for paying any duties or any fees associated with that. And their responsibility is more the financial side, the customs payment, the financial risk, and obviously like receiving the actual shipment after it clears customs. And we have the customer. The end customer. So this is someone who is actually purchasing the goods and then receiving the end package. Now, depending on various supply chain nuances, these could be the same people or the same entity or any combination of it. However, specifically for D2C parcel shipping from China to the US, it is really important to understand the differences of these three, because in this case, all of these three can actually and usually is going to be different people or different entities. And then one other term is very important to understand is DDP versus DDU. So at least in terms of e-commerce and parcel shipping from China, DDP in this case means the courier, UnExpress, etc., is assuming all the responsibilities and the costs for delivering goods to the consignee's location, and including paying duties, taxes, and customs and customs clearance. That means that whoever is shipping it using DDP methods technically is paying a rate and then not paying anything more, regardless of what the duties may or may actually be. And then DDU is kind of the opposite, is you pay the shipping and the courier is not responsible for the duties, and it is the consignee's responsibility for import duties, taxes, and customs clearing and any fees. Now, this is very important to keep in mind, is because, to be very frank, is that there continues to be some questions about just DDP methods and how DDP providers actually maintain compliance. However, one important note is that in this case, you as an e-commerce brand watching this, you're actually not any three of these. So you're not the IOR, you're not the consignee, and you're not obviously the customer, which means that regardless of any kind of compliance, questions about DDP, you're not actually responsible if something actually happens. All right, so let's first talk about how it used to work before, when de minimis was still exempt. So there used to be what's called a T86 customs clearing. This no longer works, but basically what used to happen was, let's just say you're a brand, you sell something for $30 and you use D2C China fulfillment, EcommOps, UnExpress, and consolidate and pre-label, and then basically then through these U.S. customs, UnExpress is responsible to be the importer of record, and then technically the customer is the consignee in this case, and they declare under $800, and basically nothing happens, right? Because anything under $800 just fast tracks and clears, and no one pays any import duty, and the customer gets the customer is also the consignee, and they receive the packages very efficiently. Now, so as a comparison, this is typically how DDU, so delivery duty unpaid, bulk freight works for traditional retail methods. So let's just say you're H&M, right? And you're selling a product for $30, okay? And we're just using 30% as a simple number. This is obviously going to depend on the product itself. So let's just say that the factory declared COGS is $3, okay? And they're using traditional ocean freight. And then in this case, as it clears U.S. customs, so the IOR and consignee typically is on the brand's responsibility. So that doesn't mean, in this case, H&M. It doesn't necessarily mean H&M is the IOR or the consignee, but they're the ones who are responsible for determining and getting the IOR and the consignee, and it could actually be agency services, okay? But basically, then they manage it here. They pay 30% duty on $3. They send it to a US 3PL. H&M sells it for $30, but still, this after customs already, and they ship to customers duty free. So the total import duty paid here is, $3 times 30 cents. It's like 90 cents or so, plus maybe some fees. On the other hand, there is a direct model. So something like DHL Express, which typically also is DDU. And actually, it's exactly this model that as soon as the minimis was eliminated, there was a lot of complaints from brands and end customers like using something like DHL Express that the end customers were receiving like very hefty bills. And this is why. So let's just say like you're Shein and you sell something for $30 and then therefore DHL or someone responsible with DHL is then the IOR. And then technically in this case, the consignee is also the customer as well. So the customer is also the consignee, which means, and as a reminder, the consignee is responsible for the customs payment and financial risk. And because the customer is the consignee, then technically the import value has to be the retail value because the customer is the importer in this case. Now, there's a lot of ways to legitimately reduce your declared value, but simply put, it's supposed to be more based on the so-called market or retail value. And in that case, they're paying 30% duty on $30, and the total import duty paid might be $9. Or in many cases with DHL, it was even more than that because they also charge sizable customs fees for this. So this situation was the big reason why a lot of people in the industry using China fulfillment was really concerned because they were worried that, and it'll be terrible actually for your business economics if on every single package you're sending, you're actually getting charged or your customer is getting charged the duty on your retail value, which is a lot higher than the factory value. Now, so let's talk about DDP bulk freight. So it's still bulk freight, except it's on a DDP model. So in this case, the brand has a factory declared value of say $3, and then they use some kind of DDP freight provider that organizes the IOR and the consignee. Again, it doesn't have to be them. They're the ones who organize it. And then what happens here? Question marks. Technically, it is actually a black box. And then it gets to the US 3PL. They sell it for, the brand sells it for $30 and it ships to customers duty free. Now, the thing about DDP rates is that DDP rates mostly are quoted on $1 per kilogram, which there's been a lot of questions around, well, why is it that you charge the same DDP rate even though different products clearly have different HTS codes, they have duty rates? And it remains to be a question. So this is a black box. So there was increasing concerns about, is DDP legitimate? Are they doing stuff like under declaring and things like that? And honestly, we don't know. Okay, no one knows exactly. However, everything that the brand, the shipper is doing is actually totally legitimate because any kind of compliance and financial risk is on the DDP provider. DDP rates are generally more expensive than raw DDU rates, obviously like before duty. So it is more expensive than shipping, without duty. However, there is some concerns about how it does not necessarily adjust based on the duties themselves. All right, so now we're coming into how a private courier like UnExpress is handling this. And by the way, we're using UnExpress as an example because it is they're the one that most aggressively and the earliest provided these solutions and have the highest volume right now as we have the data. However, other couriers are also expanding into these customs clearing methods. So the UnExpress DDP method was using something called T11 customs processing, which is an informal customs entry process. So in this case, a brand sells something for $30. They use EcommOps, UnExpress, whatever, and the declared value is $3 factory costs. And then before it clears customs, they consolidate and pre-label packages, with last mile labels. It goes through customs, and again, there is this DDP method here that it's not UnExpress necessarily, it's not the DPD provider, but they're responsible for figuring out the IOR and the consignee. It is very important to realize the consignee is not the customer, okay? there is a separate import process at the customs stage. And that's why it's legitimate to declare based on the factory COGS as opposed to the $30. And the DDP rate is still some dollars per kg, and there's no additional import duty paid. Now, these DDP rates are going to be a little bit more expensive than previously. However, what this does is that you're not dealing with customs paperwork, you're not dealing with fluctuations in duties, and it's just consistently, you just know what the rate is and it gets through. And then another method is using what's called the TO1 customs clearing. And actually, this is more the traditional customs clearing, usually for bulk goods. And this is something that is actually quite similar to T11, actually, except what TO1 really is only really efficient if you have much larger amount of goods. And one very important thing is that in TO1, you actually have to have more packages consolidated under a single HTS code. So that's important, okay? Whereas T11, in the same consignment, you can actually mix just a lot of different HTS codes as well. And then for TO1, one very big difference is that after this DDP route, which is still kind of a black box, the shipping labels for the last mile get affixed after it clears customs. Okay, so this is very, very important. So what this means is that technically, at this stage, there is nothing different at all than as if you were shipping DDP in terms of bulk freight and then getting it to a US 3PL and then shipping it out or selling it after the fact. Okay, this is actually quite important, and especially in the early days where people were kind of uncertain about these kind of methods, TO1 was always the most obviously compliant, because again, this is nothing that different than what traditional bulk freight does. What I mean by compliance is is it legitimate to declare based on factory COGS? Whereas for T11, okay, see, the main difference is that one, you can mix in a whole bunch of different goods, but they consolidate, they put together their client parcels before US Customs, and they pre-label it before. Now, technically speaking, the consignee in this case still can be the DDP provider. They mix 200 packages together. There is some consignee that pays duty on those 200 packages, and then therefore pays duty on the declared factory COGS as opposed to retail value. Now, initially there was a lot of uncertainty around, is this actually legitimate? Because there was a serious concern, and I had this concern as well, by the way, where the fact that they're pre-labeling, literally all their packages have USPS labels or whatever before it clears customs, is customs then going to question if the consignee is truly the DDP provider, or is it actually the end customer? Because that's very, very important. If they determine the consignee is the end customer, then that actually means that you're supposed to declare based on retail value, because then the customer is the formal consignee and importer, and you should be declaring on market value. So that was always the concern. However, and we'll show you more data, is that concern seems to be not a problem anymore, because tens of thousands of packages are actually cleared very efficiently through the T11 method using DDP methods, obviously declaring based on factory COGS, and there has been no issues, and we'll share that data later. So we feel actually very good about this. And just a brief comparison of T11 versus T01. So T11, informal entry, low value imports. T01 is actually not even just used for parcel customs, but also normally used for traditional freight as well. Last mile labeling occurs before or after customs. This is important. Technically, T11 should actually be a little bit faster than T01, but we'll see some data there. So there are some, clear benefits to each. Is in case that there is some kind of customs hold or inspection, because T11 is more on individual parcels combined together, there is less of a risk of a large batch of parcels getting held. even if it gets released, right? But it's still going to be a delay. Whereas TO1 technically is much more legitimate, like from the set customs code. However, there is some, potential limitations and risks is that there's still there used to be more questionable compliance. However, I think given the data that we'll see next, it is a lot more clear that this seems to be legitimate. There were some delays with custom inspections, but as we see, that's not really the case anymore. Whereas TO1 actually has more limits for the average e-commerce brand. So every shipment must contain the same HTS code. There's more restrictive on allowed products. More parcels may be held in a single batch. And the scalability was a little bit more questionable because for TO1, it requires this last mile process at the end of customs, which essentially means that there's a second fulfillment step at the end. So there was some questions about the capacity of something like UniExpress in order to actually support this. So now TO1 is also a little bit cheaper as well. However, to be completely honest, that for a lot of you listening, TO1 may not be something that you actually access. So first of all, TO1 methods are only really available to some bigger fulfillment centers like EcommOps, for example. And you have to have enough order volume under the same HTS code. So depending on your fulfillment center, what other clients they have, maybe you can optimize for this. But basically, if you don't have 50 or 100 packages under the same HTS code and you don't have a large fulfillment center where you can even access these lines, then you're not going to be able to use this line anyways. Okay, so just keep that in mind that if you can actually use TO1, this is probably the right choice for you. However, unfortunately, probably for most brands out there, you're using T11, which is totally fine. All right, so as I said earlier, it's not just UniExpress that's offering these T11 or TO1 lines. In terms of the top private couriers, there's also Yanwen and 4PX offering these lines as well. Now, one very important thing to note is that for these shipping lines, you have to use a large-scale private courier because whether it's a T11 or TO1 method, it requires a lot of institutional experience and capacity. And for TO1, you have warehouses in the US that needs to support this. So do not work with any small courier or no-name courier. Right now, we can only be confident to say that these large couriers, have the stable lines and nothing else. Exactly. Well, we can't be confident on anything else. So this is kind of a brief comparison of the three options is the pricing structure for UniExpress versus Yanwen and 4PX. So for Yanwen, Yanwen's a little bit complicated because they're kind of trying to test different options. So they have a DDP option, no extra duty. So for UniExpress, it's all DDP and no extra duty. For Yanwen, though, they have either a DDP option. They also have a DDU option that's based on HTS code and declared value as well. And then 4PX is also interesting. 4PX is the shipping fee plus 45% on declared value, which is also kind of odd because it's not even directly tied to the tariff rates or HTS code, right? And now, something to caution you on these two methods, whether it's DDP versus DDU plus, this percentage is there may be a misconception that if you're paying either the 4PX method or this DDU method is more compliant than a DDU method. Not necessarily, because the problem is that none of these methods have a formal invoice proof of customs payment. Okay, so because of that, if you're questioning compliance for DDP, these methods do not they do not at all change anything in terms of compliance because you're not getting customs clearing documents, you're not getting formal invoices on the customs that you have paid or supposedly have paid. So personally, I do think that this DDU method using T11 is kind of just it's just unnecessary. And typically speaking, depending on the cost, factory COGS, and the weight of your product, these tend to add up to be a little bit more expensive than a pure DDP method without really much benefits in terms of actual customs compliance or customs paperwork. And then, they also do have this range of declared value as well. So $1 to $60 for UniExpress, $1 to $50 for Yanwen, and a minimum of $2 for 4PX. And then, UniExpress and Yanwen also a lot more flexible. So they have ordinary battery cosmetic lines, but 4PX does not support cosmetic lines. One thing to note for UnExpress at least is they essentially shifted all of their lines to T11, except for like their VIP T01 line, which is not everyone can access, but all of their public lines are now T11. So when we were using like ordinary lines, a battery, what we call the regular line, or a cosmetic or liquid line, like the names are still the same. It's just that everything now has shifted to T11 because T86 does not exist anymore. Now, so in terms of like some risks so there's no formal invoice proof of your customs paid, regardless if it's DDU or DDP. There is maybe some continued questionable compliance in that way, and there might be some continued operational risk, right? Okay, like what if there's a custom inspection or something like that? What if there's a delay? However, we'll see the data later that is actually like really stable and quite good. And then for T01 shipping lines, so for both UnExpress and Yang DDP with no extra duty. 4PS is not available yet, actually. I mean, as of June 20th, at least, and it's kind of uncertain. So actually, this is all just NA because it's actually not available yet. So this is something that we're still waiting on. But basically, for UnExpress and Yang, minimum $1, and both of them just have limits. Like for UnExpress, more limited to like VIP clients. And when I say VIP clients, it's EcommOps, like fulfillment center clients, not like brands. Right now, T01 unfortunately can't ship cosmetics, but it can ship regular batteries. And then Yang has limits to certain HTS codes, and they can ship batteries or cosmetics. And then in terms of risks and concerns, there is some questionable scalability on T01 in general, just because like there is that additional last mile fulfillment at the end after customs. And there's definitely a concern that if there's any kind of concerns about a certain batch, then the entire batch, which might be 1,000 packages, it might be held and inspected at customs. However, and you'll see very soon that actually these concerns doesn't seem to be that significant over the data that we have actually seen. However, for both T11 and T01, just keep in mind that fundamentally speaking, that there are additional custom steps than previously T86. So regardless of what the data says right now, we should always be aware that there is a continued risk that you might have a customs hold or like, just an inspection or whatever. And even if it clears, with no problems, that might cause a delay. And one very important thing is that to make sure that you avoid any potential customs issues is you got to make sure that you're using correct HTS codes. You got to make sure that you're using the right courier. You got to make sure you're using the right fulfillment center that has experience using these lines and therefore operating them in the right way to avoid or minimize the risk of any kind of customs issues. All right, so now let's get to like some deeper analysis on the rates and also shipping lines as well. So before we go into, so it's going to be easier if we actually go into a Google Sheet, show you all the data. But let me explain to you guys like what the point of this chart is. So I'm going to be using this shape in future updates as well. And by the way, like I probably will do a full update like in a week or 2 weeks or so that, kind of explains, maybe some more data from the other lines. This is specifically UnExpress, mainly because UnExpress has been operating for longer at higher scale. And these are our packages, by the way. Okay, so these are like tens of thousands of our packages that we're comparing against. And the shape of this is really important so the body of this chart here is the top here is a 95 percentile and the bottom here is a 5th percentile. So basically the fastest 5% versus like the slowest 5%, okay? And this is basically the 90% range of delivery dates. This is the range that matters the most, usually when you're kind of talking about delivery date ranges, because this is the vast majority of all your packages, obviously, right? However, we also did put in the outliers. So, okay, so the slowest 1% versus like the fastest 1%. So this is what the 99th percentile is, the 1st percentile, and this is what these lines show. The reason why this is important is because, well, it is important to understand what the long tail, like what the worst case could actually be. But just note that like when you're talking about the slowest 1%, you're getting into the range of like stuff like failed deliveries because of like wrong addresses or like very rare customs holds and things like that. So I think it's very important to note these long tails, like 99 percentile outliers, but do consider them to be more outliers. And then here we have the different ranges. So this is the range of packages sent between March 5th to March 19th. And this is May 9th to May 19th. So why is this May 9th, by the way? This is important is because actually in the period like between like May 2nd to like May 7th or so, there was actually a more significant number of customs issues that actually really affected and delayed some packages. However, after May 9th, everything got a lot more stable, and it's continued to be stable. And the reason like why is because I think the first couple of days, like everyone is trying to figure out how customs actually work, or T11 or T01, and even customs are trying to figure out like what the heck like they were supposed to do after de minimis. So in those first couple of days after May 2nd, there just were more issues, but actually most of those packages cleared anyways and got delivered, except there were just kind of more delays during this first 4 days. So we consider May 9th and afterwards to be more of that stable state for T11 and T01. So looking at this, right? I mean, looking at March versus May, for the US ordinary, so this does not accept battery products, but this is the most efficient line that they have in terms of cost, is we're looking at previously this used to be like 5 to like 14 days or 13.7 days or so. And then now it's like 5.7 to like 15.5 days, which is like really actually quite good, like we think. And I think this might stabilize more and more. I mean, consider this, de minimis is gone. And there's more customs clearing steps. And the fact that on the slower end, it's just like a day or so, like a day and a half, like slower, this is actually quite good. Now, there are a little bit more like outliers. So like the slowest 1% of packages are taking like 22.3 days versus like 17.6 days before. So just caution. I mean, there seems to be a little bit more outliers still. So occasional customs holds and things like that. However, like this is like the 90% range is where you really care about the most. And then versus regular as well is, so this is kind of very similar, 4.8 days to 13.8 days, for the 90% range versus 5.4 versus 13.2 days. And then, and actually the outlier, so the top 1 percentile is actually even better for regular. And actually the fastest are even better than regular. So a lot of this is going to be like, just randomness as well. But basically like from both of these is looking about normal. So anyways, I don't want to describe like what these charts mean, but let me actually open up a Google Sheet with the actual analysis. All right, so actually, before we talk about like the shipping times, let's actually look at some of the price trends. So using this as an example, so this is like US, the weight is 200 grams and the line is regular, but let's look at the ordinary now. So, this is my point in an earlier slide. The shipping price is really stabilized. Actually, for ordinary, for 200 grams, right now is $6.78. That's only like under $1 higher than the low of last year and $3 lower than when it was the highest. And actually right now it's even cheaper than peak Q4 prices last year. So like in December 2024, it was $6.93 versus $6.78. And then, so, I mean, but that being said, that's 200 grams. So let's see like 100 grams. 100 grams is $5.83. Which is, really, really not bad compared to before, right? Before it's like $5, but like this is, and by the way, this is straight to your customers. Straight to your customers, DDP with no additional duty. Obviously, it's more expensive than before, but it's DDP and, that's kind of baked in and there's no additional duty on top of that. Now, one really good thing is that, so we have a lot of clients like shipping cosmetic products, including a brand that I'm working on, is for the liquid line, somehow, like right now, it's $6.36, and it's actually even lower than last year. It's only 3 cents like higher than like the absolute low in March, but the liquid line is actually even cheaper than last year. Which is interesting. And then now let's look at Express. Express is a little bit more expensive as well. But all of this, I mean, basically the point of this is that this trend looks very, very good. despite the higher tariffs, despite the de minimis elimination, the prices are really not that different compared to before. This is a complete DDP, no additional customs, and this is straight to your customers. All right, so now let's look at the delivery times. Okay, so this is like the underlying data of those slides that we just went through. So looking at the ordinary here, and one very important thing is the percentage of packages delivered. So as you see before, for this batch, from March 5th to 19th, delivery rate was 98.85%. And then for this May batch, it was like 98.45%. So like almost the same, like I would say. Now, this is, by the way, a lower number that's actually delivered. Like practically speaking, there's actually like, so this doesn't mean like more than 1% never got delivered, because within this is going to be stuff like just like return to sender because like the address is wrong or the customer just like refused it. And very occasionally you're going to have cases where the last mile scan did not successfully scan. So you're going to have cases where customers actually received it, but it just didn't actually mark it as received in the database because it's just based on the data. All right, so we have a lot of data here, but let's just look at, let's look at the regular. So you see the regular is really quite similar, and actually the outliers are actually a little bit like faster even than the regular from before. Now, one thing though is Express. Express is a little bit slower than before, okay? So for the Express line, I mean, this used to be a line where, so here are the percentiles. So it's really the 5%, 5 percentile, 95 percentile that you should be looking at. So before, Express was looking at like, 3-ish, 4 days to like 10 days or so, which was like, quite good. Now it's like 4 days to like 12, 13 days or so, which this is really starting to like, I mean, the Express difference is a little bit higher than the other methods. Now, just note though that like this isn't a sample of like 300 something packages like over this period, mainly because like a lot of our EcommOps clients just weren't using Express very much. They were just like using like the ordinary lines because like those are the first ones that actually had T11 support. And so this might just be variance as well. So we'll continue to look like towards this as well, and kind of similar to the liquid line. The liquid line like doesn't look very good in terms of like the current shipping times. However, during this time, there are only 100 packages that we shipped during liquid because most of our clients were cautious of shipping using the liquid line. Well, one, because it was very expensive, before. And then two, like the liquid line was something that actually took a little bit of time to actually get formally supported by the UniExpress T11 methods. However, I mean, this just is not enough packages. Over the next couple of weeks, we're going to have a lot more data for both these UniExpress lines, and also we'll probably have more data on the various 4PX, maybe Yanwen lines as well. So stay tuned on that. I mean, this video is really meant to be just like a really full primer on just everything that happened after the last, within the last month or so, and the fundamental theoretical impact and how these lines actually work. So I will most likely update this again, but more focusing on the exact details of, just more of this, like just how has this been trending over the next couple weeks. I do feel quite confident that China shipping, parcel shipping seems to be very, very stable. A little bit more expensive, slightly slower, but for most of you e-com brand owners out there, I think that looking at this data, like you'll see that it is actually fine, especially considering the fact that if you're going to be importing bulk into the US anyways, you still have to pay higher tariffs. So paying like 80 cents extra for like a 200 gram package delivered straight to your customer's door, that's not that bad at all. So we at EcommOps have remained pretty cautious about these lines because we didn't really want to like very proactively promote these lines, because we even had some concerns about compliance, about speed, about operational risk. However, like at least as of June 20th right now, I can confidently say that I think that, or actually I do believe that China direct parcel fulfillment is stable. It's getting back to normal, and I predict that it's actually potentially going to get more and more stable as couriers continue to optimize. And I think that the shipping times will just potentially get better and better. Although just keep in mind though on the prices is that I don't expect that these prices to continue to keep dropping though, because like, well, it's also supply and demand as well. As China fulfillment becomes more stable, more and more people are going to use these lines, which drives up the volume, and then potentially these prices are going to go up, especially as we go into peak and Q4 season. So stay tuned. In the next couple of weeks, I'm going to do another update of this, really focusing more on the details of how these shipping lines have been trending in terms of price and shipping times as well. And but before then, I mean, as of now, I think that if you have been using China fulfillment, considering using China fulfillment, especially if you have access to UniExpress T11, if you're working with either EcommOps or established fulfillment center that can actually that has experience using these lines and doing things correctly, then I think that as of now, as of June 20th, I think it's a great time for you to start using China fulfillment again and having that be a very, very important mix into your supply chain strategy, shipping products from China directly to your consumers into the US. All right, so thank you guys for listening. Again, this is Dayu from EcommOps. If you're interested in working with EcommOps, if you're not already and you want access to these lines, just note that we do have a minimum order requirement of 30 orders per day or so. But if you're interested to talk to us, we'll put a link below. So please check us out. But otherwise, until next time, again, this is Dayu from EcommOps. See you guys next time.